Hello traders, Gary Wagner here. It is 11:09 in Honolulu, 4:09 in New York on Thursday, 9th day of March 2023, and this is the daily report for gold and silver. Tomorrow, the Labor Department will release the non-farm payroll jobs report for last month, the month of February. Currently, they are anticipating that between 200 and 225,000 jobs were added last month, and that unemployment will tick down from 3.5 to 3.4. What if the analysts are wrong and we see the jobs report come in under estimates? If that is the case, it would create strong bullish headwinds for gold. The opposite is true. If it comes in well above expectations, we could expect gold to drift lower. Gold today had a respectable gain, a gain of $16.90, almost a full percentage point, 0.93%, with the most active April contract currently fixed at $1,835.50, while the vast majority of today's gains were the direct result of traders bidding the precious yellow metal higher. About a third of today's move can be attributed to dollar weakness. The dollar is currently trading down by 0.36%, and the dollar index is currently fixed at 105.265. Lastly, silver had a small decline of about 0.1%, or 2 cents, taking March silver futures to $20.13. We've converted the short-term 240-minute chart to a daily chart. The reason I'm doing that is I want to show you a 3-day pattern simply called a three-river morning star. It begins with a large red candle, a star that falls below the real body of the red candle, and then a recovery candle. In the case of this recovery would be an upside candle, green, the larger the better. If you recall from Tuesday's show, following the $37 sell-off, which took gold to $1,818, I said that I believed that the sell-off was exaggerated based on fear and probably overdone. I also believe that there was a probability that we would see a bounce to the upside and that the B or counter wave to an ABC correction was most likely not completed. And I illustrated that using a short-term chart. We're going to do that, but with a little bit more detail now that more data has come out. And what I'm talking about is the fractal nature of Elliott wave. And what I mean by that is when we have, for example, this wave 4 that comes down, it's typically broken into an A, a B, and then a C. However, within that, we can subdivide that even more into a minor wave count behind the first count. So this first move in A could be looked at as a 5 count, with this being 1, 2, 3, 4, and 5, completing our A wave. You can do that on corrective waves as well as impulse waves to the upside. I also postulated that the current B wave that we're in is possibly not complete. One of the best ways that I have used over my years as a technical analyst is to use Heikin-Ashi charts in conjunction to creating my wave count, because what you get is a clear series of solid green or red, and that indicates the conclusion of one wave component to the next. So that when we look at this ABC, as I said before, we could break that down into a 3 count, which would look something like this. The first of the ABC would be A, and you would get an A, a B, and then a C, because it is a counter wave, and the counter waves have ABC. And then on the B, it could have a 3 or 5 count, and they would be numbered. So I believe we could be seeing something like wave 1, which has already completed, We then would go into our second or wave 2, and we would be in our final third. The third is where I would look to see the final move to the upside, which would take us to the conclusion of our B wave, the counter wave. As you know, typically we look for a move between 50 and 75% of the price decline that we saw in the first wave down, which is our A, and it doesn't have to go that high. We could see it go as high as 1850. We could see it go as high as 1870. But typically, textbook, we look for a move between 1930 and 1892. That being said, I now want to discuss the trade alert that I sent out yesterday and the implications for the aggressive traders that are still long. The trade alert that I sent out the other day had 2 recommendations for our subscribers that deem themselves a more conservative trader in the futures markets and those that are aggressive. The conservative traders have taken a profit. If you got out at 1831 and in at 1828, you made $300 per contract. We currently have gold at 1835, but as I said, it will all depend on tomorrow's jobs report. Our aggressive traders are still long from 1828. I might send out a trade alert to raise the stop prior to the release of the jobs report. If I do not, aggressive traders can use their own formulas to move their stops up. But here's the thing. The January report was anticipated just above 100, I believe 180,000 new jobs added, and the actual number was 517,000. My assumption is we will not see another repeat of January, where the estimate comes in at 200,000 and the actual numbers come in at 500,000 or 600,000. If anything, I would expect the report to be on target or possibly slightly lower. That is because recent data suggests that unemployment has risen, and more importantly, although the labor market is tight, there will not be as many jobs available because of the massive layoffs in the tech sector, which would mean that we wouldn't get as strong of a jobs report as the forecasts are currently anticipating. If that is the case, I would expect to see an initial jump in gold from current pricing to approximately 1850. That would be the first level of potential resistance. However, if Tuesday's CPI report comes out and shows that there has been a slight decrease in inflationary pressures, which is what the current forecast is expecting, then we could see gold trade even higher, and I would look for gold to go to between 1880 and 1890 as my most optimistic viewpoint, which is where we would look to pull profits. This has been Gary Wagner wishing you as always good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.